The Doc's new investment option.
Lead Bullion.
Buy your ammunition from the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly's Metals and Markets Wrap. Joining us again this week is perhaps our favorite returning guest on the show, out of London, Alasdair Macleod. Thanks once again for joining us, Alasdair.
That's my pleasure, Doc. It's nice to be with you again.
Okay, well, we're recording this in the afternoon on Friday. Of course, the markets were closed today for the holiday, so nothing of much excitement to report today in the gold and silver markets, and really for the week, for that matter as well. Pretty tight trading. With really the big news, or the big story in the markets, is that gold was pushed back under 1,300, closed the week actually below 1295 at 1293.90, and silver closed the week pushed back under $20, right around the $1950 mark. So what are your thoughts, Alasdair, as far as the action in gold and silver? We remarked on the show last weekend that there certainly appeared to be a concerted effort by the cartel to restrain or cap both gold and silver at the $19 silver level and the 1,300 gold level. Is that your take and perspective as well?
Yeah, I think it's a very interesting juncture. First of all, if I can start with gold, open interest generally has gone down to the lowest levels we have seen since the Lehman crisis, and that's really saying something. This recent dive down under 1,300 has been accompanied over the last week by a sudden increase in negative Gofo rates. Now, what this tells me is that the physical is drying up. Not only is it drying up, but to the point where there is now a backwardation in the London market. So you've got really a tussle, I think, between the paper boys on COMEX and the physical buyers. And if nobody's going to provide the physical, then the price will go up, I think. So on that basis, unless there is a central bank going to step in and ease the market, I actually think that we're probably got a reasonable week ahead of us. Silver is also very interesting, but really quite different. Open interest there is right up at the top of the range at over 160,000 contracts. And every time they bash it, sometimes you just sort of feel this is going no lower. It's like they're sort of hitting a concrete floor and they can never quite get it down a bit. And then something else happens and they manage to get it down a little bit more, sort of thing. Like, suddenly it's sort of $30 sell-off in gold, and that gives them the excuse to be able to knock, say, half a dollar off silver. But what's interesting is that at these levels, there is very solid demand on COMEX because that's what the open interest is telling us. And when you look at the numbers, the feeling I get is that this is, fabricators, businesses that need silver, for example, solar panel manufacturers, people like that who need silver as a raw material. They're just taking the opportunity to buy it while they perceive it's cheap. And I think that's very interesting. So very divergent numbers on the open interest between gold and silver, but each equally fascinating in its own way.
You have any further thoughts, Eric, on this week's trading and the $20 level in silver and 1,300 in gold?
Sure. Silver tends to be a leading indicator as to where gold is going to go in the next 24, 36 hours, give or take. The mining shares also perform the same role. And if you look at silver trading on Thursday, it actually was performing pretty good relative to gold. Gold was still being pushed down, but silver buyers were coming out of the woodwork. The day before, on April 16th, we saw the spike down before the London opening, and then immediately was bid up. And in fact, it was bid up so strong during the course of that day that when COMEX opened, people were a little edgy when looking at their short positions, and there was a small short covering rally. So, there's every indication at this point that anytime silver gets close to hitting the lower end of 19 bucks, there's very strong demand, and the fact that we're seeing that adds up yesterday's trading, today being a holiday with no trading. I think that does confirm what Alasdair is suggesting about next week, that You know, this is the lower end of the range in both gold and silver that the cartel is able to execute price management efforts, and we'll probably see some bounce back coming into the market next week. There's no particular reason why, on a fundamental basis, that we should be trading lower and lower every time the cartel acts like this. And their previous bottoms is probably going to serve as the bottom this time around, because the fundamentals have only grown stronger for the case of owning precious metals.
We wanted to specifically bring Alasdair on the show today here to discuss the excellent report you released on April 4th, Alasdair, regarding Chinese gold demand and your revised estimates of the massively upwardly revised estimates of Chinese gold demand. So why don't we let you discuss that a little bit further, if we could?
Yeah, sure. My starting point on this is the knowledge, and it is knowledge, that China has a geopolitical strategy to be the powerhouse in gold. And all her actions point in that direction. And I first noticed this some time ago when her fellow members of the Shanghai Cooperation Organization, which is, sort of, if you like, a security and economic bloc incorporating most of Asia. All these central banks were buying gold, and I thought, now this is interesting. So there is a strategy afoot whereby Asia actually takes the West gold, and that has now been going on for some time. We've also seen that China has been advertising government-sponsored advertisements to persuade people to buy gold, and I think this is interesting because on the one hand you've got the states buying gold, and on the other hand it's also encouraging its people to buy gold. And I think there are two basic reasons for this. As far as the state is concerned, you've got to bear in mind that she's got a short 1.3 trillion tied up in US treasuries. Now, she can't really access that money. She can access it perhaps as those treasuries mature, and then she can sell some off. But she's actually sort of rather stuck. She can't do it too much for the very simple reason that otherwise she drives her own currency up against the dollar. So there is, if you like, a requirement for some sort of strategic counterbalance to that. And if you think about it, gold is the very natural counterbalance. China has now accumulated an awful lot of gold. I don't know how much, but if someone told me that the government had got somewhere between 5,000 and 10,000 tons, I'd believe them. If someone told me that the people in China had anything between 10,000 and 15,000 tons, I would believe them. We're talking about an awful lot of gold. And if you've got gold in those quantities, it's very easy to flip the value of your reserves from your dollars into gold. All you do is you just push up the price of gold to somewhere between $5,000 and $10,000, depending how much gold you've got. You can then write off your US treasuries, and you've got your value back in gold. Now, I'm not suggesting that it's part of China's game plan to actually do that. But what I am suggesting very strongly is that China likes to have that sort of power as a basis against which she negotiates her international relations. So that is really my starting point in the whole thing. Now, there are, I think, two basic types of information that come out of China with respect to gold. You've got hard numbers. For example, the Shanghai Gold Exchange deliveries is one set of hard numbers. Another set of hard numbers is the import, export, and re-export figures provided by Hong Kong. Now, that doesn't give you a complete picture, but it gives you something of a picture. And the Shanghai Gold Exchange will tell you that they have delivered into public hands around about 2,200 tons in 2013. If you look at the additional bit that comes in from Hong Kong, removing double counting as much as you can probably add about another 800 tons to that. You've then got that's the hard information. The information which you've then got to play around with and try and deduce, and numbers don't really help you here, is government activity. Now, what is I find very interesting about this is that I talk to refiners and I talk to vaulting companies, and they tell me that they have never seen a Chinese refined 1 kilo 4/9 bar. Now that tells me very, very clearly what I suspected all along, and that is that the government are taking all their own mine production. And not only mine production, but also their scrap production, because obviously that will be recycled through the Chinese refiners. We know that the huge quantities of refined gold going into China from the Swiss refiners and from the Rand refinery as well. There are 4 big refiners in Switzerland, and they are working 24/7, 7 days a week. I mean, this is just quite extraordinary. The tonnage that's going through, I don't know what it is, but when I asked one of the directors of one of these refiners, he was very much of the opinion that if I said somewhere between 10 and 20 tons a day, that's probably about right. This is a huge, huge amount of gold just going through Switzerland. So you can see that the numbers that we have from the Shanghai Gold Exchange and also Hong Kong's import, export and re-export figures do not actually tell the whole story. If and the assumption from other analysts, and I see that Koos Janssen assumes this as well, that what happens to domestic production and scrap actually is part of the mix that gets sold to individuals. Now, I'm saying that that's not true. In other words, the numbers that we're seeing going to individuals are considerably greater in terms of the drain on world gold resources, to the tune of the mine production, which is roughly 430 tons last year, and scrap supplies, which we don't have a figure, but I've guessed at around about 350 tons. I'll just say something about scrap. Scrap is not old jewelry. I mean, there is a little bit of it, but very, very little of it. There is a very little, I suppose, a figure like sort of 10, 15 tons of scrap, which comes from, sort of industrial recovery. But the vast majority of it is gold which has been delivered out of the vaulting system into public hands, and very often recast so it's branded. When you get a market which is rising, I mean, obviously some people look to take a profit, and so they will sell that gold back into the market. But that market is treated as scrap because it has gone outside the vaulting system. So you can see that scrap numbers can be really quite high. And I think in 2011, 2012, it was recorded at well over 400 tons. I figure like 450 tons from memory. Sounds about right. So. Right. These are big numbers. Now, you've also got, apart from what's actually delivered out of the system into public hands, you've also got vaulted gold. Now, this one is a bit of a mystery, and it's a bit difficult to get much of a handle on. If you look at the numbers that are put out by the Shanghai Gold Exchange, and the Chinese government also produce a sort of a gold annual book. Neither of which they're doing now, incidentally. The last numbers we've got are 2011. That does indicate that there is a vaulted element in there. And I think if one assumes that the vaulted element grows at a similar rate to the growth in demand from delivered gold, then you can see that suddenly, the numbers are beginning to pile up. Now, I also know that, again, talking to my friends in the refining industry, that the gold that they're getting now, which is coming from places like London, it looks like it's really from the bottom of the vaults, like it's old stuff, it's low grade, I mean, some of it's sort of barely 0.9 rather than 995. And also it's dusty and so on. So it looks like, they're coming to the end of the vaults. Now, we're talking about huge quantities of gold which have now left the central banks, monetary gold, which have left the central banks, and has now gone into the anonymity of Asia. And as well as China, of course, you've got the Chinese diaspora all around Southeast Asia. They like gold as well. I mean, the point is there are 4 billion people in Asia, and these guys treat gold, they regard gold as their pension fund. They're not like us. They don't sort of take a sort of Keynesian view that, the gold standard was a barbaric relic and, gold is just a commodity now. And, oh, by the way, if we're facing deflation, then commodities are going to go down, so you better sell gold. No, they look at it the other way around. If if you're going to get trouble, if you like, in the economy, then the best thing you can do is put your savings into gold. And I think, what we have seen so far with the lower price that was pushed a year ago, virtually today, when it collapsed through the 1500 level, I think that that just triggered the most enormous wave of buying, and it was like a gift from heaven for all these Asians. They'd never imagined they'd get gold so cheap. And that's what's happened. And so having made the mistake of trying to persuade the West that we are actually in a bear market and therefore you ought to sell your ETFs, they just completely underestimated the demand that will be triggered and have to be met in order for this, the management of the gold price to succeed. And that's where we are.
And certainly we've seen evidence of that throughout Asia with the massive gold demand by the public. Queues and lines that look like something that would resemble a Black Friday TV giveaways here in the U.S. where customers line up for a week or 10 days before the sale starts to get $50 or a few $100s off of a television.
Yeah, absolutely. And, I was hearing anecdotal evidence of, coin salesmen or people with gold coins, sort of going to trade fairs and finding that they sell everything before they even before the trade fair opens. They've always got an empty table there. I mean, it is extraordinary how popular gold is, and it's a big, big reminder to all of us that gold actually does have a monetary role, and to forget this rubbish about gold being no more than a commodity.
Yeah, and we should tell our listeners as well, too, to be sure to check the write-up for the show, because we will include the table that Alasdair put together for his last report. You can see all of these numbers and put it into context of what we're talking to. But the bottom line is that global demand, including China last year, according to Alasdair's estimates, was 7,603 metric tons, compared to the world supply minus China's internal development of roughly 3,600 metric tons. So it's almost double what mine supply and sales from ETFs being approximately 900 metric tons last year, and various other sources from vaults. So demand is more than double supply, and obviously that can't continue forever. That's why we are in fact seeing floors every time the cartel attempts to attack the metals.
Alasdair, I'd like to get your thoughts a little bit here on where you see silver heading in particular for the second half of the year. I think we're both under the belief that both gold and silver are likely headed higher for the second half of this year. Do you see silver retesting the 26 level that proved support prior to that takedown early last year? And if so, do you think that'll kind of mark the top of its run for this year, or does silver have a chance to work through that resistance to the upside up beyond 26?
I think it has a chance to work through that resistance, and I think that when the situation changes, it could actually change very, very dramatically. I don't quite know what's going to trigger that change. I have sort of in my own mind a view that a loss of confidence in the dollar, I think, could be very, very important for gold and silver. Silver broadly moves at about twice the rate of gold. So, if gold gets up into new high ground this year, which I think is more than likely given the economic dynamics and monetary dynamics that we have at the moment, if that is the case, then silver, could easily get up to the sort of $60, $75 range. I mean, we could have a very, very big move. And the other thing that's interesting at Gold Money, we find that there have been periods when people put in almost dollar for dollar into silver and gold. So, at current prices, they're buying 65 ounces for every ounce of gold they buy. And the other thing that's interesting is if you look at the performance of the ETFs, there's really been no investment liquidation worth mentioning at all through a really torrid time when the price of silver has fallen from a high of over 45 down to under 20. I mean, it is actually quite extraordinary performance, if you like, underlying performance. It's not reflected in the price, of course, but at some stage it will. And I think that, I mean, underlying all this, with no stock around, and with the central banks having leased, I'm sure, pretty well every ounce they could possibly lease, or nearly, there's going to come a point where they can't rescue the bullion banks from their short positions. And there have been several occasions over the years where it has been necessary for the central banks to step in and produce, sort of reimpose some order into the market. But I can't see how they can do it in future. And the fact that the New York Fed was only able to deliver 5 tons of Germany's gold, and they should have, bear in mind, 1,531 tons left now. They could only find 5 tons. I mean, this is crazy. If I was running this sort of scheme, I think I would at least have said, well, we've agreed on 300 tons over the next 6 years. What we'll do is we'll sort of, over allocate the target in year 1, and that'll shut everybody up. But no, they could only
keep the fears up a little bit.
They could only find 5 tons. I mean, there is no gold there, is the message I'm getting.
And one other statistic here to evidence that we've discussed in the past, and we touched on earlier, is the Gofo rate that is once again plunged negative. And looking at data all the way back prior to the 90s, I think since early January 1st, 1989 through the 7th of July of last year, there were only 7 recorded days in which Gofo was negative. But since last July 7th, the Gofo rate has been negative over 50% of the time. It's plunging negative once again. So in my mind, that's just one more statistic that shows or demonstrates the overall tightness and lack of physical supply in the gold market.
I think that's right. I mean, my take on this is that I would expect to see more negative Gofo days because of the very, very low level of the interbank rate. If you've got zero interest rates, then it doesn't take a lot of volatility to drive things negative. But having said that, obviously, if you've got a negative Gofo rate, then someone should step in and supply some cash bullion in order to take the benefit. But nobody's doing that, and there are 2 possible reasons. One is nobody likes the counterparty risk in the market, and so far I don't think there's much evidence that that's the problem. The other problem is that just nobody's got any bullion, if you like, to supply to do the arbitrage. And when it sort of lightens up and you find that suddenly we're going back to positive, I guess what that does, it marks the moment when someone, some central bank, has actually managed to put some leased gold, deliver some leased gold into the market. So that's probably what it marks, when we go back into positive and then we go negative. But I was just very interested that this time round we've gone negative and they pushed it below 1,300, and that tells me the London market is effectively cleaned out at this price.
Yeah, it speaks to their desperation. We should also point out to our audience, too, just to flesh that out further for understanding purposes. What Alasdair described in the second case is very indicative of the confirmatory nature of this Gofo data for the last year or so being just completely outside the bounds of normality, which most likely speaks to the fact that central banks have excessively leased out their gold. I mean, putting aside the question of whether or not physical bars are there or not, but we know for certain, given what the data is showing us, that over-leasing has gotten to the point where, yes, they can't get Germany more than 5 metric tons in 2013, and this Gofo rate is a clear indication that there is no official sector gold in any kind of volume that could rectify what is, by all accounts, a completely crazy and an insane level of Gofo reporting as it has been in the last year. Nothing like this has ever happened, ever, and it speaks to a very big problem that's most likely lurking under the surface with central bank gold. And excessive leasing, hypothecation to the point of 15 people or countries having claim to every bar within the Federal Reserve system. Unfortunately, that could very well be the case. No one knows for sure, but that level of distortion is probably more true than not. It's not conservatively estimated.
Well, before we wrap up here, Alasdair, any other thoughts on what to expect for the gold and silver market going forward? What are your thoughts as far as a long-term perspective? The excitement obviously is out of the market. Certainly not the excitement we saw a couple of years ago with the metals rallying to the upside, but from a contrarian point of view, those who understand the fundamentals, this would seem to be the perfect time to either initiate initial position in precious metals for insurance purposes, or else to build on your position.
I go along with that entirely, Doc, and I think the amount of debt there is around the world is now so great that all the combined money printing of central banks has failed to stimulate the economies. We've got too much debt to do anything. It's actually a catastrophe. We now have in Europe a number of countries sinking into deflation. Now, the Keynesian reading of deflation is completely different from mine. I don't think it's a problem at all in terms of the pure economy, but where it is a problem is that if you are over indebted, then effectively the burden of your debts rises as prices fall. So this is the thing that everybody, I think, is now worried about in the central banks. This is why they're trying to warm us up for negative interest rates in Europe. They're trying to warm us up for more QE. I mean, look what's happened with Japan. They have accelerated QE with an intent to double money supply over a period of, or the quantity of money over 2 years. And what's happened? The economy is collapsing. So this is, I think, going to lead eventually to far, far higher gold prices, simply because the other side of the price equation, which is the paper currencies face ultimate collapse. May not be in this cycle, but if it is not on this cycle, I will be quite surprised. I think that's the big sort of background reason, if you like, for owning gold. And, thank you, central banks, for selling out all our gold to give us an opportunity, those of us in the know, to actually buy some at an incredibly cheap price. Meanwhile, stuff the rest of us, because that's what they're doing. I mean, there is going to be no gold in the West, and paper currencies collapse. In order to get the gold back, we're going to have to provide services and goods to Asians at a price they're prepared to buy it off us in gold. I mean, that is it's a ridiculous situation. We've got rid of the most valuable asset we have, really. That's what all this gold suppression has done, and I think that we're going to reap the whirlwind.
I think we couldn't agree more with that, Alasdair. Any other thoughts before we close, Eric?
I'd just like to underscore that the numbers that Alasdair has come up with are probably 50% to 100% above in terms of estimates of Chinese demand and world demand by extension than what the mainstream has been looking at. And this disconnect speaks to part of the reason why the West is continuing to snooze through this period and continue to believe that at best gold and silver are just consolidating, or worse, are in a bear market. I mean, when we look to the World Gold Council and Wall Street brokerage houses in their analyst literature and what have you, the consensus is just counter to object reality. I mean, I remember, I believe it was 2 shows back when Alasdair was with us, and we were kicking around the very same discussion. And I was talking about the back of napkin numbers that I had run for 2013 and seeing pretty much similar numbers that Alasdair has done. And what he has done that's different in particular from the mainstream is that he's got a very compelling estimate of individual customer vaulted gold in China, and You don't see the World Gold Council trying to wrap their brains around things like that, and they continue to have an emphasis on jewelry as being the primary investment driver in China, when in fact I think that's a fundamental disconnect between how to actually categorize setting up your basic analysis. They just do not have a way of capturing the demand effectively that goes to the individual in China from an investment point of view. So they chalk it up to the percentage of gold that comes out of Hong Kong servicing the jewelry industry in mainland China, and call that an analysis. And I don't want to bash them too hard, but even when you look back to 2009, when China had suddenly come to the world and said, guess what, folks, we have now official reserves of 1,054 metric tons, when their previous reportage, I guess, was like, if I remember correctly, 5 years prior to that. And every single year, the Gold Council, the World Gold Council, did not have any kind of change estimating the obvious continued flow into China. I mean, it was obvious to all observers that China was, importing a huge amount, and just because they didn't officially declare it, the World Gold Council didn't do anything when it came to their estimation. And I cite them primarily because they serve as the benchmark that analysts at Wall Street firms look to first to establish their models and then work and refine thereafter. So basically, we have the entire Western mainstream financial community with its head buried in the sand. And Alasdair's done a wonderful job with these numbers. That's one of the reasons why we wanted to have him on the show right away to talk about this stuff, because more and more people need to take a really hard look at his case, and we'll provide the article that he wrote on April 4th. So I'd encourage everyone to take a reading of it over the weekend.
Yeah, Alasdair, excellent analysis. Keep up the brilliant work, and as Eric mentioned, we'll include a link to it on the write-up for the interview, so anyone who didn't see it when it first came out a couple of weeks back, definitely take the time during this extended weekend here to analyze it in depth. So it's great to have you back, Alasdair, and keep up the brilliant analysis.
Well, that was my pleasure. Thank you very much, and thank you for your very kind comments, too.
Okay, for the Doc and Eric Dubin, we'll wrap up the show here, so thanks for tuning in to the SD Weekly Metals and Markets.
The Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.